Sorry. Good morning. It is now 9:01 a.m. and I'll call the Sewage and Water Board of New Orleans Special Pension Committee meeting to order. Special Counsel, please call the roll.
Director Kennedy,
Here.
Director Pacia,
Here.
Director Anthrop, Director Thomas, Councilmember Hughes.
Here.
Ms. Johnsey.
Here.
Mr. Makbul.
Here.
Mr. Joseph. 5 members present. We have a quorum.
Thank you very much. For the special meeting, we have a number of presentation items, and we will begin with, let me catch up. Marquette and Associates, Mr. Alberto Rivera.
Hi, good morning, everyone. Filling in for Kwaku, but I have been working in the investment consulting space for over 11 years, so big shoes to fill, but good hands for today's meeting. I work with Kwaku closely on a lot of public relations, so I'm familiar with some of the side letter discussions that were going on, so can help with some of those questions there. But really just wanted to take this time to give a recap of why infrastructure, the search, and then dive in through a search book, which is performance is a bit dated, but the themes kind of still stand there for the managers. So with that, infrastructure, the infrastructure space is an investment in physical assets that are really required to operate and sustain the economy, as well as industry and social growth. So some of the benefits, which one of the main one is timely here, inflation protection. So we'll see how this manager set up the portfolio to protect against inflation as well as some GDP sensitivity. Another benefit is the long asset life, which aligns with the objective of the retirement fund. So long-term investors, that aligns well. As well as some regulatory oversight, which leads to stable and predictable cash flows, which is what we're looking for in this space. Similar to fixed income, but with different risk and return characteristics. So as a reminder, the portfolio currently has a 7% allocation to global infrastructure. This is listed, and it is through Cohen & Steers. The managers coming in today will be private open-end managers, so they aren't exposed to the day-to-day volatility that we would see from a listed infrastructure manager, helping dampen the overall volatility seen in the portfolio. So that's one of the benefits, as well as just a diversifier within the portfolio. And I don't know if you guys have the search book. We passed it along. So I'll begin with that, and it will be on page 3. It highlights the 4 candidates, but for these comments, I'll concentrate on the 3 presenting today. So I don't know if that's part of the printed material.
Of each individual.
Yeah. So I guess quick commentary here. Macquarie would be the newest of the 3 candidates. That's just specific to this fund. They have an inception of November 21st, but Macquarie does have over 30 years of investment experience in the infrastructure space. So just wanted to give that there in case there was any questions with how young the fund was. And then additionally, the managers will each go into what they bring to the table and how they see the infrastructure space. But I did want to highlight some of their differences here. So we see Brookfield, which is the first manager up today. They are about 82% of their portfolio is invested in utilities. And this leads them to high visibility when it comes to cash flows, as these are regulated, so they're able to see what is coming in. They will also be the more conservative manager, as when we look at performance, they have the lowest standard deviation across the other 2 candidates. So that's kind of the flavor that they bring to the table there. Where IFM, that's majority of their investments, or 53%, would be in transportation. So think toll roads, airports, seaports, things of that nature. So that is more GDP sensitive, although IFM does have protections with that, as far as being able to raise prices as needed to kind of combat inflation there. So that's something that we'll go ahead and ask them to provide some additional color there. But that would be two main differences from Brookfield and IFM, just that different approach. And then with Macquarie, they have about 48% in utilities, which is regulated, high visibility to those cash flows. But in addition to that, they also have some contracted cash flows when it comes to some of the energy sector. And energy is really the big differentiator for Macquarie among the other two candidates that I'll be presenting today. So those three slightly different flavors, all core infrastructure managers, all institutional quality. So all very good managers there. And just to cover some of the questions here, majority of the investments across the board will be here in North America, but there is exposure to Europe, Australia, and Asia across the board. And then additionally, I did want to point out the fees. So currently Cohen & Steers is 87 basis points. This is your listed infrastructure. And happy to say that the three candidates today are cheaper than that fee. As an example, Brookfield is at 75 basis points, IFM at 77, and Macquarie at 72. So if there is a switch, we would capture some fee savings there right away. And then lastly, just because I know it's one of the questions here that the legal team was bringing up, redemptions are quarterly. If there was any need to redeem from the fund, they would just need a 90-day notice ahead of the redemption. And that's the same across the board for the three firms presenting. So that's really quick, the comments that I had prepared. Happy to take any questions. And if not, I'll bring Brookfield. Like I said, this is the more conservative manager with their approach.
Question, Roberto. So I know that we're all core infrastructure here, but it sounds like immediately and after a review, preliminary review, it looks like the managers approach it differently. Like you said, different flavors. Do we have, and I would be pleasantly surprised if you said yes, do we have the size of investment that would allow us to split our investment and enjoy more than one strategy?
Yeah, so we can. I'm looking here at the minimum investments. They're 10 million for IFM and Macquarie with 5 million for Brookfield. So if there were to be a split, down the middle at 10 apiece, that would be manageable, yeah.
This is a 20 million allocation.
Yeah. Thank you.
What is the total allocation amount for this class?
20 million. So it's 7% of the portfolio. It'll fluctuate slightly depending on where assets are currently.
And are their fees negotiable or is set?
I think they're pretty set at this point. I know I would have to double check if these have it. Marquette does sometimes have negotiated fees for our clients. So I have to double check if any of these managers would have something like that. But I think for now, this would be their best and final fee.
Are we currently contracted with any of these firms right now and any are the asset classes? Because some of these names are familiar, I just don't remember if they were selected.
Let me double check the portfolio here really quick. I don't think so, but no.
What was the question?
If there's any current exposure for these managers, correct, in the portfolio?
Other asset class.
No.
None of these, okay.
I think we're ready to get started.
Should I just bring the Brookfield guys over? And have them stand here in the front, which.
Yeah.
That way, okay. Where's the basin?
Oh, this one, generally we.
There's only two people, they can just sit here or there, either way. Welcome, I can see them. Clicker, pretty small group, but
Morning.
got some materials for the group, if that would be helpful.
Great. Thank you.
Yeah.
Thank you much. Thank you.
Thank you.
Matt, Chad, Kennedy.
Hi, Becca Johnsey. Nice to meet you.
Alberta, are we supposed to? You two, or can we just reference this?
Actually, is there a preference? Do you guys want them to go through the clicker on,
Or can we
the
just
screen
reference
or
page
just?
numbers?
Yeah, that's up to, whatever you guys are comfortable with.
Okay.
I mean, it's, that part is really how you best want to present, right?
Perfect. We'll probably just reference page numbers for the group then. Well, good morning. Thank you for the time. We're excited for the opportunity to present Brookfield Supercore Infrastructure Partners, known as BSIP, our open-end core infrastructure strategy for consideration this morning. What we hope to do in this time is start with a brief introduction of who Brookfield is, provide some context on how we approach infrastructure investing, and then spend the majority of the time on the BSIP strategy and its portfolio and how it could be a foundational piece for an infrastructure allocation. Before we get into the bulk of the discussion, on page 2, just to go through the team, my name is Garrett Washenko. I'm a client relationship manager working with institutions across the Southeast. I'm joined by my colleague, Matt Press, who is a managing director and part of the BSIP senior leadership team. After a few opening remarks from myself, I'll pass it over to Matt for the majority of the time to walk through the strategy and the portfolio. Starting with Brookfield at a high level on page 3. Today, Brookfield is a large global asset manager with over $1 trillion in assets under management. We're supported by 250,000 operating employees and 1,400 investment professionals with a local presence in 30 countries globally. On the bottom of the page, you can see our core investment verticals on the page. As you can see, infrastructure in the bottom left-hand corner, we have $247 billion. It is one of our flagship investment capabilities. But really what the key on this page is we have a 125-year history of owning and operating critical assets. Brookfield actually started as a family office in the late 1800s, investing its own balance sheet into infrastructure assets. We only recently started taking third-party capital within the last 25 years. And this is important because that owner-operator heritage informs and drives how we invest today. And we invest in those essential assets that are critical to the backbone of the global economy. Particularly within infrastructure, which I know I've already touched on with the $247 billion, one of the largest, if not the largest infrastructure platform in the world. We invest across all subsectors of infrastructure, but tend to try to focus on regulated assets or assets with long-term contracts and strong cash flow visibility. This allows us to, and we operate them effectively, and it allows us to generate consistent income and strong risk-adjusted returns for the long term. And while Brookfield is a global firm, if we take a flip to the next page, our business is inherently local as well, as seen by our presence here in Louisiana. We've been investing in Louisiana for nearly 2 decades so far and have deployed over $8 billion worth of capital in the state. We maintain a large presence with our operating employees and have investments across infrastructure, real estate, private equity, and all our key investment capabilities. We also have very long-standing relationships with other public pension plans in the state, north of a decade long there. And maybe to really bring this page to life, we want to spotlight a recent infrastructure investment, Colonial Pipeline. So Colonial Pipeline is the largest refined products pipeline system in the US. As you can see on the page, 2 key junctions here in Louisiana, and this system actually goes all the way up the East Coast to the New York City area and supplies about 50% of refined product demand for the entire East Coast, including servicing 8 different airports. And the key takeaway from this page is Louisiana is an important state for us. It's one that we continue to invest in. This Colonial deal was actually made almost a year ago to the day, so very, very recent. So we continue to invest in Louisiana and we continue to develop relationships in Louisiana for the long term. And that word long term parallels really well into infrastructure and infrastructure investing. As investors like yourselves are considering building your infrastructure portfolio, it is extremely key to invest in those high quality assets that can deliver consistent income, inflation protection, stability through market cycles, and very strong risk-adjusted returns that can be used as a cornerstone within your infrastructure allocation. From our perspective, BSIP, the strategy we'll be talking to you about this morning, was designed to deliver on just those points: consistent income, inflation protection, stability, and strong risk-adjusted returns. If there are no, I think we're taking questions at the end, but at this point, I will pass it over to my colleague Matt to walk through the strategy.
That's great. Thanks, Garrett. That was awesome. Good morning, everyone, and really appreciate the opportunity here to meet with you today. I wake up, live, go to bed, dream about the SuperCore strategy. So Brookfield SuperCore Infrastructure Partners, the acronym will be BSIP. So I'll just use BSIP going forward here. And I'm super passionate about what we do and really do think that we're delivering significant value to our 300 plus investors in the fund. Before jumping into the slides, what I wanted to do is just level set on the answer to the following question, which is, what is infrastructure? Now, what I think is funny is that most people around this room actually have a unique perspective on the answer to that question versus most that we speak to. But essentially, we're talking about the roads that we drive. It's the telecommunication towers that delivers the Wi-Fi. It is the sewerage system that delivers that transports, cleans, and stores our water. Like, these are all essential infrastructure assets. And yet, not all infrastructure is created equal. And the reason for that is that there are certain assets that are riskier than others. And when you look at investing in infrastructure, you look at it as Garrett mentioned, diversifying, lower risk, and yet how do you square that with not all infrastructure is created equal? And so that's our job here today. Our job here is to sort of peel away, open the veil into how we see the world of investing in lower risk infrastructure assets, which is what BSIP was designed to do. We have a specific kind of definition for lower risk infrastructure that we think is unique. And so we're here today to articulate that and make sure you understand why we think BSIP should be the bedrock of any institutional investment portfolio.
Do you all invest in municipal bonds?
No. So we're investing in hard infrastructure assets. We don't have an allocation for public securities where there's much more variability in returns.
Where you guys are located?
So our headquarters is in New York. The infrastructure business is global. So we have a large office in Toronto. So I'm based in Toronto, where the CEO of the infrastructure team is based. But we have a big team in Houston. So one of the president, essentially, and the chief investment officer for the infrastructure business is based in Houston. We also have a large team in London, in Sydney, basically all around the world in key markets. So on slide 5, just very quickly on the fund. So what is BSIP? BSIP is Brookfield's flagship core infrastructure strategy. It's an open-ended fund meaning we're in it for the long term. We're buy and hold investors, we're pretty conservative, we're basically a bunch of accountants and just investing in lower risk infrastructure for the long term. It's a $15 billion fund today with 29 operating businesses, so very large scale, very diversified, where almost 100% of the cash flows coming from our assets are either underpinned by regulation or a long-term contract. So essentially, these are the lowest risk assets you can be investing in. And as a result, we're able to generate a steady 10% return. Now, that 10% return may not be the highest in the industry, but let's go back to my original question about how we define infrastructure, right? This, we believe, is the lowest risk strategy in the market today, and we're delivering a consistent, stable 10% return through market cycles. 8.5% net return, and then a stable cash yield. So BSIP was designed 10 years ago as a sleep at night strategy, buy and hold, and designed to perform through all seasons. So if you flip to the next page, what you'll see, and investors continue to tell us, is that they appreciate BSIP because it's done exactly what it said it was designed to do 10 years ago, which is to deliver stable returns, whether or not it is through a global pandemic, through a period of high interest rates and high inflation, wars, tariffs, you name it, BSIP continues to deliver a steady return. And so that's that dark blue line that's just up and to the right, very stable. We're not trying to, buy assets, wipe out the management team, add a bunch of debt, and then hit a home run on exit. That's not what the strategy does. It's set it and forget it, buy and hold, steady as she goes, 10% return, regardless of what's happening in the broader market. And if there's anything that I want to leave you with, or we want to leave you with here today, is this slide. It's that definition of infrastructure. It's lower risk. It's set it and forget it. For us, it's kind of like that duck analogy where everything is, not, above the surface, it's calm, but underneath, we're working really hard to make sure that we're managing these assets appropriately, and that's why you see that steady and stable performance.
I wanted to ask you one question based on your graph. Look like you shield your investment pretty good from market volatility and inflation. What are your strategies to shield?
Sure. So every single asset has some form of inflation protection. So it may have direct inflation linkage where revenue grows as inflation grows, or there are set escalators that are higher than the historical rate. So every single asset has some form of inflation protection, and we also mitigate a whole bunch of other risks. So interest rates. So we protect the portfolio from higher interest rates. Today, every single asset has long-term fixed rate debt in place. It's on average about 9-10 years, and that protects against higher rates and higher inflation. So why BSIP? Really, the rest of the presentation is based on 3 pillars of how we answer this question. Number one, we're built on the shoulders of one of the world's leading infrastructure platforms. Number two is our strategy is different. Again, it's focused on lower risk assets, not trying to do anything, too crazy, and generating that stable performance as a result. So we believe that if you've got the right team, the right strategy, you can deliver fantastic results. There are no donuts in the portfolio, no underperforming assets. All the assets in the portfolio are either achieving or slightly ahead of our return expectations. So moving on to the first pillar of why we think we're different is the team. Garen, already kind of touched on it, so I'm not going to spend too much time here. But I think one key thing to mention is our 125-year history of investing in this sector. The majority of people that work at Brookfield, we have a very, very large operating presence. The majority of people that go to work are, operating. They're operators. They're people that are They're not going to work in white shirts and blue ties, like they're going to work in hard hats and steel-toe boots. And why is that important? Is because it speaks to our DNA. Like we have every quarter, we talk about the performance of our assets. And the first item on the agenda is health and safety. You know, are people coming home at the end of the day to their families the same way they left in the morning? And that's important because it speaks to our DNA as owner-operators and the fact that we really care about, you know, how people are coming, you know, how bringing themselves to work and coming home at the end of the day. This is not just about, you know, raising money and investing it. Like, this is a people business, which is critical to how we do our business. And then lastly, I would just say that, you know, we came at the infrastructure business fundamentally different than most peers in the market. We were owner-operators first. We invested off of our own balance sheet. And then we figured out how to raise capital later. Whereas most other managers were in the private equity business or venture capital, great, super successful, raised, you know, a lot of money, great performance, and then came to infrastructure and figured out how to manage the assets. We're completely the opposite, right? We're operators first, then we figured out how to raise funds after. And on slide 9, what you'll see here is the team who's actually responsible for the strategy. And to be honest with you, the entire infrastructure business, which is about 500 people, are responsible for delivering the strategy. Now, we have a group of dedicated folks. You'll see there, sort of 1/3 down from the top of the page. There's 5 names. Those people live and breathe the strategy every single day, which is important because it's an open-ended fund. It's going to be around much longer than anyone else, you know, at the company, and so we just need to make sure we have succession planning. We have a team that are really focused on it every single day. You know, in terms of the team, obviously I'm not going to go through all the names here on the page, but just to give you a flavor for how we transact, and you know, everyone is responsible for sourcing and originating new transactions, but it's one team. So for example, we acquired a business called AusNet back in 2021. This is the electricity transmission and distribution backbone of the state of Victoria in Australia. So how did it work? Well, we have a team in Sydney. They knew the players in the market. They sourced the transaction, but then they called up Natalie Haddad, who's the head of BSIP, and also is our specialist on utilities. So that team, there are a couple names here on the page, Ray Neal and Jonathan Seller on the right-hand side of the page. They called up Natalie. As a group, they looked at the opportunity and they raised it up to Sam Pollock, who's the CEO of the infrastructure business, to make sure that Sam was on board with this being a BSIP investment. And then we're off to the races, and you have a bunch of other names on the page that were involved. Why I say that is because, again, it's just about that global team-based approach and how we source and execute transactions.
I have a question. On your Americas team, are any of the managing partners African-American female?
Yes, so Chloe Berry is managing partner. She's responsible for treasury and capital markets across the infrastructure business, so globally. She's actually a portfolio manager for one of our strategies, but she's at the bottom of the page under extensive infrastructure platform. She is a global leader of our strategy. Natalie Haddad is the head of the fund. So she is the portfolio manager. She has ultimate accountability for the performance of the business. Just to slide 11, in the interest of time, it's important that we highlight the strategy, why it's different. It's because of all these attributes here on the page. You know, we're focused on only highly essential assets that are located in the highest quality geographies. The assets are only driven by 2 things: regulation or long-term contracts with inflation protections, high creditworthy counterparties. That's it. And so we've stripped out a lot of the risks tied to volume. So in other words, we're not investing in airports. We're not investing in toll roads. Those would be exposed to broader market volatility. Like if you invested in those assets during or before the pandemic, you would have seen you would definitely not seen a core, you know, risk profile. Those are great infrastructure assets, just not good for this particular strategy. those are higher risk. Again, coming back to how we define infrastructure, better suited for our core plus strategy or higher risk strategies, just not for BSIP. BSIP has a transportation asset in it. It's a portfolio of transportation hubs in Spain that are backed by contracts. So when the pandemic hit, it didn't matter. You know, these are basically trains and buses in Spain. You know, volume, so the people traveling in that network dropped by 50%. We received 100% of our revenues. And it's because we have contract in place with the local municipality. So as long as those assets are open and available for use, you get paid, inflation protected. So it's that layer of additional protection that just, and that was a great example, that just validated the low risk nature of this strategy. And so we have all these different attributes, including cash yield, stable cash yield. All these assets are operating, so they should generate a stable cash yield. And then lastly, financing. You know, we've been at this business for over 100 years, and we know that financing can really negatively impact businesses. So we take a very conservative approach to financing. And then lastly, you know, the strategy hasn't changed. We're not moving out the risk curve to generate higher returns. We're steady and stable and are dedicated in ensuring that we're adhering to that strategy.
I'm sorry, I'm just gonna interrupt Chairman Kennedy. So is the reason we need to keep the door open?
You know,
For some
legal,
purpose.
we have
Okay.
certain rules with public meeting laws. I let them manage to
Just
that.
wanted to make sure,
Yeah.
because we are having some difficulty.
So, yes,
Focusing.
so if it gets a little too loud, you know, we can pause and clear, you know, make sure everyone understands. So yeah, if it gets too loud, just let us know. We'll pause, make sure they understand they have to keep it down. But legal here keeps us, that is the.
That makes it
rule.
literally an open meeting,
Yeah.
because it's literally profitable.
Yeah, so Louisiana special.
Gotcha. Well, we wouldn't turn them down if they walked in, it was closed, but it's
Right,
literal.
literal.
Well, we're happy for anyone to listen. Okay, this is great.
I did have a question for you. So since this is an open fund and you're currently at 15.5 billion with 29 operating businesses, and you said you had quarterly reviews, is that quarterly reviews to see if we're needing to add because you've raised more capital? Is it to see their performance? Like at what point does that 29 businesses change?
Sure, so that's a great question, and we are constantly evaluating the portfolio. So not even just on a quarterly basis, every single day, we're looking at opportunities to add. We're not actually looking at selling investments at this point. We would, opportunistically, we get approached, but that assessment, the buy, hold, and sell assessment of any of our businesses is ongoing. When we think about performance, you know, we have operating performance reports coming in from our portfolio companies regularly, not every day. They're infrastructure businesses, they're not sexy, they don't change that much, so we don't, you know, we hear every couple weeks, you know, every month from our portfolio companies. But otherwise, you know, and then on a quarterly basis, we sit down as a large group with the CEO and Natalie, the head of the fund. We go through every single asset. All of our teams globally report on performance, what's happening, health and safety. If an asset is underperforming, if something's going on, that information is communicated. It's a very flat organization, not highly bureaucratic, which is one of our strengths. So we can act quickly whenever things, you know, need to be addressed.
So you have about 10 of these identified businesses in the United States, but represents 51%.
Yeah, that sounds about right. Yeah, so, yeah, go ahead.
So I was gonna wait until then for my questions, but this kind of steps right in with what I was wondering about. So open-end fund, very attractive, great presentation. See the defensive core, like this gets it done. My question is long-term, we're in the first decade. And so do we ever turn into a closed-end fund? Are there any metrics around, any goals around, hey, we're gonna turn this off at some point? And if so, similar to asking about sales, are there any restrictions in, you know, how we're investing? And then I'll throw in my other question. I saw renewable power was pretty significant. Can we talk a little bit about that? Is that where we're finding some extra yield, some alpha, or is that also a core strategy? Because when we think of renewable, we think that's, sexy compared to the pipeline and, old school. So if you would, jump in there.
Amazing questions. So I will start with investment restrictions, then talk about the strategy, any changes, and then talk about renewables, just in that order, if that's okay. So in terms of investment restrictions, actually, it's great that we're sitting on this page. We have restrictions on what we can do, for sure. And it comes down to our definition of core infrastructure. We label the fund super core just as a way to, just for marketing purposes, like ignore the labels. Like basically, we're just investing in assets that meet all of these criteria. So by way of example, from a geographic perspective, it's OECD markets only, but not all OECD is even created equal. Like we're not investing in every OECD market, but we have a bucket for very highly rated countries that are outside the OECD, but even that is minimal, right? We have a single investment limit restriction on the fund. So there are restrictions, and we're just investing basically within the bounds of what you see there on the page. And why is that important? Is because, how we define our investment opportunities, it's very narrow. It's basically all of these attributes here, including our target 10% return. As a result, that's why you see very little volatility in our returns, because we're not investing in stuff that's gonna generate 5% and then offset that against 15% to get to a 10. And then you see some variability, but you still get to your 10. That's not what we do. It's all these attributes, including the return target that we're looking to meet, and as a result, it's very low risk. So to quickly answer your question, yes, there are investment restrictions. It comes down to this page and how we define lower risk core infrastructure. Number two, change in the strategy. Today, it's a $15 billion fund. After, we started to incubate the fund 10 years or so ago. We started investing since the beginning of 2019. We can see the fund growing. At the beginning of this year, we set a target of doubling the size of the fund within 3 years. So we're on track for that. It could be 20 billion by the end of next year or so, which would be great. That doesn't put a limit on what we can do. If anything, it increases the opportunity set, because as we grow, we raise more capital, we can do larger, more unique deals that other people can't do. So it's a bit of a differentiator for us. And through that time, we don't plan on closing the fund or shifting to Core Plus. At Brookfield, we have separate and distinct strategies for each part of that risk return sort of continuum. Mm-hmm. And we already have, we've launched marketing for our 6th vintage of our Core Plus strategy, very separate and distinct from this. So, we're strictly adhering to the strategy. We're planning to do this for the long term. And then on renewables, so we've been looking for renewables for a long time. Not all renewable projects are core. So let's start there, which is another 20-minute conversation. I can go into the weeds that'll bore everyone to sleep, but not all renewable projects are core infrastructure, but these ones are. And we couldn't find core renewables at a 10% return for 7 years until recently. High cash yielding, stable, all based here in the US. Long-term contracted, we have a strong partner in place as well. So we're actually ecstatic about finally adding renewables to the portfolio. We have investors who are constantly asking us, why don't you have renewables in the portfolio? It's a diversification question. So yes, it's very different than our gas distribution networks or our electricity transmission or telecommunication towers. It's very different, but we think that's a positive because it does add diversification to the overall portfolio.
And keep in mind, most of the renewables have very short life cycles. So it may not be a very good investment, because from my understanding, any renewable has very short life cycle compared to the conventional.
Yeah, so I would agree with that. I would say that some of our assets are perpetual. So like a water, sewerage system, this is a perpetual asset, like this isn't going anywhere forever. A solar panel has 15, 20-year lifespan, right? Now, is that very, very short in the context of an infrastructure asset? I would say no, if it has, all of the right attributes, it's financed on a long-term basis, got a strong counterparty, 20 years, where you're putting zero value at the end of the asset's useful life, that checks all of our boxes. And if it has a 20-year useful life, like that works for us. But not all assets are like that, so I would agree.
Maybe it's
In the interest of time, I've got it. I know, I can keep going, I'm sorry, I can keep going. Okay, perfect. Slide 15, let's jump ahead, just on performance. So we've talked about the team, we've talked about the strategy. We believe that once you've got the right team and the right strategy in place, you can deliver fantastic results. And that's what you basically see here on the page. I'm not gonna go through all the numbers, but if you go to the top left corner, the gross time-weighted return in 1 year is 10.1%. And then if you just track along the line, you'll see in the 3, 5, and since inception, it's basically 10, 10, and 10, right? Very stable, very resilient, and it comes down to all of those factors, the inflation protections, the long-term financing. And if you go to the bottom of the page, you look at the net yield. So at the end of the day, what are our investors getting? It's basically 4 to 5% cash yield. So on a gross basis, we're targeting about 4.5 to 6%. We've delivered 5.4% since inception. And so again, that cash yield is very stable, and people really appreciate BSIP because it is done exactly what we said it would do in delivering those steady and stable performance. No assets are underperforming, and there are no skeletons in the closet. Nothing to hide here. So, and just to wrap up again, I think we've been able to just, if we wind it back to my initial question, which was, what is infrastructure? What is lower risk core infrastructure? And we think that as, a manager that's been around for over 100 years, doing this for a long time, we've got the right strategy in place, and, the performance speaks for itself. And so we appreciate the time. Sorry that we went over a little bit, but we respect, the time here today. We thank you for your time and attention, and we would appreciate, your partnership going forward. So thank you.
Great job. One question. Are you all ready to receive funds from Louisiana?
Is there a contribution queue, and what wait time would be associated to the queue?
So today, we are looking at about a 9 to 12 month period for an initial capital call. Now that can change. Today, so in the last, I didn't get a chance to talk about this, but over the last 9 months, we've been able to sign and close about $9 billion of transactions. And when we forecast out the amount of capital that we've raised to date based on the amount of capital that we need to close those transactions, we're basically at the amount that we need to be, which means that any new transaction, it also depends on how much more capital we raise, would see quick deployment.
Okay, thank you.
And what is your lock-in time?
So it's a 3-year lockup.
3?
3 year.
Yeah, and since, so we've been around for, 8 years or so plus, we've raised 14 billion, over 10 billion is out of lockup, and we've seen less than 2% of redemptions. Meaning, we've got 10 billion of capital or more of people that can leave if they really wanted to, and they're all staying in, and if anything, the conversations that we have are with people, looking to top up into the fund, not necessarily looking to remove it.
Thank you.
Any other questions? Okay. Good job.
Thank you so much.
Thank you so much for your time today.
Thanks.
Appreciate it. Thanks.
Thanks, everyone.
Thanks.
Any questions, a break, or?
Yeah, just want to check in with everybody.
Question. In the past, this committee has been very adamant about diversification in reference to Jack's question. Is that still an issue? Is that still our position or not? Just want to be clear.
I think that's a relative individual question. I think, you know, it matters, the number of members, myself included, if you want to receive funds from Louisiana, want to know about your ties to Louisiana. If you want to receive funds from a population or a workforce that's majority underserved with less attention, I think those are valid questions. I don't see anything changing in that regard. I want to know.
Yeah, okay. That's the clarity.
Sure. All right.
I mean, based on the structure of the company, it looked like they have plenty of diversity.
Yeah, I'm satisfied. I don't, you know. You know, we got the pre-information, so I kind of looked up, and so I've got those questions answered for myself, of their background, the family that started the fund, because that's also a concern of mine. As you say, 100-something years from one family, well, which family? I need to,
Yeah.
that's a concern, that may be concerning.
Alright,
I'm good with those questions.
yeah, when he said the late 1800s, I just had to go look at the endnotes. 1899. So I'm just trying to see, where are you with abolishment of slavery? What were you investing in at that point? Did you have any involvement in the enslavement of people? So,
Anyone who had that type of money back then, I would be surprised if their hands were clean.
had to.
But that family has nothing to do with what's going on today.
Exactly,
That's,
exactly. That
they're
was-
out of it,
Yeah,
so,
that's the way I look at it.
all right. Anyone else before we can? All right.
Yeah, so just a quick recap for Brookfield, they will be the more conservative strategy within the three candidates. So you can expect singles and doubles with them. Like they said, they're not aiming to hit a home run in the portfolio. And that shows in the performance where they may trail some of the other candidates, but looking at the search book here, over 3 years, they had about 0.9% of standard deviation, which is the measure of risk. And then relative to IFM, which is the next manager, had 3% of standard deviation. So that in itself just shows their focus, and super really does fit, because it's not basic core, they take that extra layer of safety. So with that, IFM is the next up. They have exposure to more GDP sensitive, which is an area that Brookfield avoided, with the exception of the transport, which did have contracts. So I'll go ahead and bring IFM, as I think they take a similar approach for their transport allocation.
That's your buddy, ask him.
Anywhere here?
Yeah.
I can probably click the slides from there if you want.
I can do it, but, all right.
Okay, perfect. Appreciate it. Thank you very much for inviting us here this morning. It's great to get in front of you all and connect and talk about IFM and our infrastructure fund. My name is Gary Harrison. I'm a director in the client service team in IFM Investors. I've been with the firm for over 10 years. Before that, I was with Oppenheimer Fund as well as Transamerica. I'm joined by Ian Pearson, who's an investment director on our infrastructure team. Ian's been with the team now for over 7 years. Previously, he was with GE for over 7 years and Con Ed beforehand. So the plan here today is try to just dive into, give you a brief overview of who IFM is, talk about our infrastructure equity platform, and then dive into the fund performance and give some examples of some of the types of investments we typically look for in this portfolio. On this page here, you'll see IFM has been in the infrastructure space for over 3 decades. So we really are infrastructure equity specialists. Our current assets under management are about $177 billion. You can see over half of that is represented in the infrastructure equity asset class there in the center of the page. On the right side there, we've highlighted our 17 global office locations. Our firm is headquartered in Australia. If you talk to some infrastructure shops, you'll likely hear some Australian accents over time. That's where the asset class came out of, was that country. But you can see the 17 global locations, including offices here in New York, Houston, Texas, and Toronto, Canada. We think it's important to have these global offices. It's important to have boots on the ground, investment staff, working with operators, being close to where we hold the assets in the fund today, as well as being aware of any upcoming regulatory changes or any new deals coming through the pipeline. So that global footprint is very strategic in terms of sourcing new opportunities. On the left side of the page there, you'll see our ownership, and this really is unique. At the end of the day, we're not a listed company. We're not owned by a principal. We're owned by pension plans. So with that, they have a long-term outlook in terms of how they're investing. They're not worried about short-term profits. They're not worried about a share price or anything of that nature. They're worried about making sure that their underlying members that they represent get the long-term savings requirements that they need and hit those performance objectives that they've targeted. So our owners that are highlighted there actually invest in this flagship fund, the Global Infrastructure Fund. They represent about 23% of the assets under management. So you can see that compatibility with in terms of that outlook and the importance of making sure that we hit our net performance objectives, because not just our global investors, our owners are also exposed to that fund as well.
Can you define your infrastructure portfolios? What exactly you are investing in infrastructure?
Yes, absolutely. So we're attacking infrastructure from a core returning space. So we're looking for operating assets, primarily in OECD countries. So think of North America and Western Europe and so forth. And really it's those assets that are the backbone to the local economy, right? We're looking for these types of investments that can operate and hit those returns over various market cycles, regardless of what's going on in the macro environment. So if you think of transportation like toll roads, ports, airports, utilities, we also have some data centers in the fund as well. So it's a pretty diverse portfolio. The fact that it's, at this page, we'll touch on that here a little further in terms of the fact that this flagship fund that we own it's a large fund. It's been in operation since 2004. So it's incredibly diversified in terms of the geographic and sector exposure it has, as well as the underlying investments, but also that vintage diversification as well. There's not many other funds out there that have a 20+ year track record in this space. And that's what our flagship fund has there in the middle of the page, the Global Infrastructure Fund. You can see it's an open-ended fund. It currently holds 23 portfolio companies. That's further diversified across 170+ underlying assets. Again, we have some investments that are in the fund that have been in there for over 20 years. It targets net returns of 8 to 12% over the long term as well. And so part of that combination will also be the appreciation and cash yield that these assets generate, because again, these are mature operating assets. So at the end of the day, there's steady yield coming from these investments back to the fund. And this is an area too, I just want to stress, in the core infrastructure space, size and scale matters, right? There's a lot of benefits to being such a large fund in terms of sourcing opportunities that other managers can't access. So the average deal size of the portfolio companies that we're looking at this fund today are in excess of $2 billion. Right, that's just a space not all managers can function in. But also the fact that we have this mature portfolio built to date, there's a lot of opportunity for us to reinvest capital back into these portfolio companies as well. So instead of having to go out to the market, forced to look for new opportunity, we're able to reinvest capital back into the fund that provides accretive returns for our investors without having to pay a premium for new acquisitions. This slide here touches on our current investor base. I highlighted the fact that we originated and headquartered in Australia. You can see the real growth from our client base to date is in the Northern Hemisphere and primarily here in the US. We're continuing to see tremendous appetite from plan types of all accounts. So whether it's public pension plans, corporate plans, insurance, endowments, and foundations, and so forth, they're seeing the benefits of infrastructure as an asset class. I think over the past years where we had coming out of COVID, coming out of a higher inflationary interest rate market, infrastructure as an asset class, private infrastructure, has held up. Those returns have been able to continue to be met. And again, we're seeing that continued growth in that area today. This slide here touches about our track record to date. So as I mentioned, the fund's been around since December of 2004. The targeted net return is 8 to 12% for this portfolio. And you can see throughout all those annualized periods there, we've been able to deliver on that return target. We are a total return focused fund, so we don't have a dedicated cash yield because we think it's best to operate these assets with a long-term mind in place in terms of how do you derive the most value over that period of time. But as I mentioned before, they're steady yielding assets, right? They're operating, they're mature, they're providing that cash yield back to the fund overall. We then, at the fund level, can disperse those distributions out to clients if they prefer, or they can elect to reinvest those back into the fund. That's something that clients can change their election on an annual basis. But I just want to highlight there too, because as I mentioned, we have been reinvesting back into this fund over the past 3 years. Many of these portfolio companies had CapEx programs underway. So some examples there is some of our port assets. We've been deepening the berth space so they can manage larger vessels. We have an airport in the UK that had a runway that was able to meet double the amount of passengers that a terminal was able to meet there. And so over the past couple of years, we had a Terminal 2 expansion program where we were able to reinvest capital back into expanding that terminal space so we could maximize the amount of runway space that the airport was provide. That CapEx program is coming to conclusion on time and on budget. So that cash yield figure you see there as well should start to tick up going forward as those other programs we've been reinvesting back into have started to come to their conclusion.
Sorry, can you go back? I'm looking at the infrastructure equity slide you had. You said there's 23 portfolio investments. So you have 23, like how many investors are in this fund? And how many businesses does the 68 billion represent?
Yeah, so in terms of individual portfolio companies, it would be 23.
Okay.
But then some of these portfolio companies are incredibly diversified. So sometimes there's a single asset, like we own here in the US. We own the Indiana Toll Road, that's one toll road. There's another asset in the fund, like Aqualia, which is the water network that has relationships with over 800 plus municipalities. So it's incredibly diversified. Some of these are just at the portfolio company level, but some of those portfolio companies have hundreds of underlying assets exposed to them and contracts and municipalities involved. Yeah.
And your number of investors, I saw the sectors which are represented on the next slide, your investor base, but like what is the amount?
Yeah, so we have over 750 clients that are currently invested in the Global Infrastructure Fund. That includes several Louisiana-based clients that are in excess of about 200 million. And again, I mean, this is a space here where I think if we look at it from a global perspective, allocations to infrastructure in the US lag behind other geographies. So here in the US, you can see allocations to infrastructure anywhere from 0 to 5 or 7%. If you look at Canada, sometimes that figure is in the teens. Europe and Australia, it's even higher. I think we're continuing to see that growth and evolution of infrastructure as an asset class here in the US as public pension plans start to focus again on the downside protection that infrastructure provides, as well as the yield and appreciation aspects that we have in these investments, as well as the inflation linkages that all the portfolio companies that we have tie back to as well. With that, I'll touch on the global infrastructure team here. So again, we have a large dedicated infrastructure investment team. So the team today is approaching about 150 underlying members, solely dedicated to infrastructure investing. So this doesn't count any of the members at the portfolio companies. This doesn't count our legal or tax people or sales people. These are all folks that sole job is to go out there, source opportunities for the fund, as well as actively manage these investments over time. So the benefits of having such a large team is the fact that once these deal two members do the work in terms of performing due diligence on these assets, they stay on and manage these assets. So whether that's through board representation, we'll also second members of the team directly into these portfolio companies. So with that, I mean the members of our investment team will go and work at the actual underlying management companies. And again, work closely hand in hand with leadership there. They build out their network. They again get to work in geographies that they can get better understanding of the regulatory environment and then bring that skill set back to the group. So it's a great retention tool for the team, but it really helps diversify their expertise and knowledge over the long term as again, we're an open-ended fund, so there's no set timeline where we're looking to exit or anything of that nature. So having an investment team that can go through this process, evolve, continue to grow is a key strategic advantage for us.
So you said that these 23 key businesses, has there been major turnover of that portfolio, or has it pretty much remained the same?
So when you say turnover at the portfolio, do you mean in types of the underlying portfolio companies or like management at the portfolio companies?
which companies comprise those 23? Like, have they been pretty standard?
Yeah, they've been pretty diverse. So again, we're a buy and hold manager, so we don't look to acquire these businesses and exit it after a 5-year period or anything of that nature that you might see in a PE asset class. So there's investment companies that we acquired in 2004, 2006, they're still in this fund to date. So again, that's some of that diversification benefits I touched on earlier, where again, the fact that this fund has been around for so long, it got early exposure to where many of these sectors and portfolio companies. And as a new clients come in, commit to this fund, they get exposure to that diversified portfolio completely. It's not like a client comes in and then just gets exposure to new investments going forward. A new client gets immediate diversification to a 20-year plus fund that's incredibly diversified. And with that, I'll pass things over to Ian, who can talk about what it is exactly that the Global Infrastructure Fund invests in.
Sure, yeah, thanks, Gary, and thanks again for the time. We're very much grateful for the opportunity to share a bit more about our fund today. So I think Gary hit on a lot of the high level points, but I'll try to add a bit more color to kind of what we focus on, how we approach it, and then dive a bit more into the assets that we have in the portfolio that our LPs benefit from, and that any of our potential LPs that come in will then benefit from going forward. So at the top of the page, as you guys are aware, we focus on OECD jurisdictions when we're looking for new assets. And the 3 buckets at the top, the utilities, energy, and transportation, that's generally where we've spent the majority of our time, and the underlying buckets beneath that is kind of what you'll see in the mix of portfolio companies that we have in GIFT today. But what I want to spend a bit more time on is the bottom half of the page, because that tells you a bit more about the characteristics and traits of the types of companies that we look to focus on when we're looking for new investments for the fund, because not all infrastructure assets operate the same way, right? And to be clear, we do look for all of those traits when we're looking for assets, but the first 3 are probably what I would want to leave you with and as the key takeaway here. And first is the strong market position and that high barrier to entry, and how that'll often present itself as actually in a monopolistic type of asset. And that can be, explicit monopolistic positions. So for example, many of our concessions actually have clauses in it that are explicit protections against competing alternatives being constructed within the concession term, which is obviously a pretty attractive feature. In other cases, it could be a physical constraint or a geographic constraint. The Indiana Toll Road that Gary mentioned is wedged between the Great Lakes to the north and a number of municipalities and towns to the south. So if you wanted to create an efficient, economically and physically alternative, it would be very difficult to do, right? So you look for those types of things when you're assessing these assets for the fund. The second one is the long useful life, and again, that's the physical useful life. These assets last a really long time, but also in the concession life, right? For example, the Sydney Airport, which is in the fund, that's the gateway, the primary gateway in and out of the Australian market. That concession term lasts out to 2097. So it gives you the ability to really underwrite and as well as invest in to grow the assets over the long term. And finally, the concept of the inflation protection, that third one there, which Gary also hit on. And the idea there is you want assets that obviously can participate in the upside when you have high growth, attractive macroeconomic circumstances. But it's great when you can also have elements of the way that asset operates that protects you to the downside, or even can create growth in high inflationary environments. For example, the Indiana Toll Road, it is exposed to GDP. So when GDP is growing, you get more vehicle traffic, et cetera. But it also has an attractive mechanism in the concession framework that allows for annually an increase in tolls at the greater of 2%, nominal GDP per capita, or CPI inflation, right? So if you've got good times humming and you have high GDP, that's great for your road. But if you have kind of those lower growth or maybe no growth environments and inflation's really raging, you can participate in that as well, which helps to stabilize and create resilience in the road and also in your portfolio. And there are other cases like that around our fund. So I think it's a really important part to just keep in mind as we describe the Global Infrastructure Fund.
Sorry, quick question.
Sure.
Would majority of the transportation assets have concessions like that to protect against that GDP sensitivity?
Yeah, we have some materials that we could share, but yeah, a lot of them do, right? For example, I work on the Aleatica asset, which is our Latin American toll roads platform, which I'll spend some time around. But it's a little bit of a different function, but the regulated regime that they have in place, it's a different business model. It has an inflationary aspect to how the contracted return mechanism is calculated. And so naturally over time, it wraps that inflation into the way that you underwrite the asset. And so you have implicit inflationary protection. So it's quite common, and we look for that when we add assets to the fund. So Gary, I don't know if you mind to the next page. So that was the what. This is a bit about the how. And investing in infrastructure assets and managing them over time can be complex, but we like to kind of distill it down to these three key pillars, which is first, it's seemingly obvious when you want to buy well. But for us, we do think we're quite uniquely positioned to do that, and we're advantaged in that front. The first is the depth of the team that Gary talked about, the 140, 150 dedicated infrastructure specialists we have around the world. But it's also the relationships we've built in the infrastructure space over the past 30 years. Starts with our management teams. Obviously, these are C-suite and executives that have decades of experience in infrastructure, but also the partners and the stakeholders that we work alongside. Those can be government agencies and authorities. We have partners in a lot of our assets that we've developed over time. I think the Singapore Ports Authority is a great example. It's the largest port operator in the world. We sit alongside them in our Baltic Hub investment, which is the largest container terminal in Poland. And so working alongside those types of best-in-class infrastructure operators globally can create opportunities for you to get to the front of the line and see new investment opportunities before maybe they hit the market. And so those proprietary channels for originating investment opportunities really is for the benefit of our LPs, and we've seen that work quite well over time. The second element of the approach is managing actively, and particularly today, it's evolving time. We really like to have, if not the entire asset, really strong governance, controlling, or at very least co-control positions when we invest in new assets, because that gives us the ability to really drive the business plan that we're underwriting on behalf of our LPs and our investors. It also involves great relationships with our management teams, having the board seats that Gary talked about. We have over 60 board seats across our portfolio, the 23 portfolio companies we talked about. And that gives us the ability to influence things like the operating budgets and the capital expenditure plans, and making sure we can push to increase revenues across our assets consistently over time, as well as putting in class not just value creation initiatives, but the things you'd expect from any responsible infrastructure operator: safety, governance, quality of service for the users of our assets across the globe. And then finally, to the point you asked about, like Gary said, we generally don't underwrite our assets with the obligation to sell at any defined point in time, but when it does make sense, we will sell either partially or entirely on an opportunistic basis. That'll usually happen for one of two reasons. One, if there's an opportunity to further diversify the fund in a way that we think could be beneficial, or simply sometimes a potential buyer comes to your door with a price that is too good to not consider, and so we will take those opportunities as well. A few examples include last year I helped lead the partial sale of one of our larger toll roads in Mexico, so we sold a minority stake. We retained a 51% controlling position, and in that case we sold 18% of our side to a local investor backed by Mexican pension funds. So a like-minded investor, but for a number of reasons helped to further de-risk that asset in our position there. So that was a great opportunity from our perspective. Another one was more recently. We fully exited our position in Colonial Pipeline last year. That was an asset that we entered back in 2007. It was one of the longest held assets in our portfolio. And at the time of acquisition, I think it represented about 28% of the fund. So a very different time. Whereas when we sold last year, it represented less than 1% of our fund, right? And it was a minority position, not something that we would seek out today. We still viewed it as a very attractive core infrastructure asset, but just not a strategic fit for what we were trying to accomplish for our LPs. And so we took the opportunity after a pretty positive regulatory outcome with FERC in 2024, plus some tailwinds that came in with the new administration around the midstream sector in general. We aligned with our co-shareholders in that asset and sold the entire asset for a pretty good outcome for our LPs. So just wanted to give you a flavor of, we do opportunistically exit when it makes sense for our LPs, but we aren't forced to. So I think that's a pretty unique position and helps us to manage the fund on behalf of our investors. So maybe to the next page, I'll try to, just in the interest of time. Gary highlighted the diversification in the fund. We're really proud of it. Presents itself in a mature, geographically dispersed set of assets underlying those assets are the 160 plus underlying companies and assets that those portfolio companies manage. And I think what this affords us and our investors is not only the opportunity for continued growth, but also resilience, which we think is really important when you're thinking about investing in infrastructure and choosing a manager. And diversification doesn't just stop at the geographic spread. There are many layers beneath that we intentionally manage around the fund as it relates to diversification. I think transport is a great way to kind of give you a feel for that. I spend a lot of time on toll roads. We've talked about the Indiana toll road. I've talked about the Aleatica platform, which is actually 20 different road. It has one airport and a couple other things, like 2 ports in there, but it's mostly roads spread out across Mexico, Italy, the UK, and some other countries in LATAM. So already you see roads can be very different in terms of geography, but also traffic mix, right? The Indiana toll road runs from right outside of Chicago, which is the border of Ohio. Of course, there are folks that take that road to work every day, but north of 70% of the revenues are actually generated by heavy vehicle traffic. It's a systemically important freight corridor from the Chicago hub and then out and in from the eastern parts of the United States, right? So that's a very different profile from some of the roads we own and operate outside of Mexico City and Milan that are focused on commuter traffic. Some of them are entirely by the contract, only allowed to have light vehicles, and they serve as congestion relief for some of the free alternatives, right? So when you have good cycles, they operate maybe differently, but also during down cycles, you'll have differing performance across these roads, which again is an attractive feature for the portfolio. And then revenue mix as well, right? Some are purely volume linked with some of those mechanics around the tolling increases that we talked about with ITR, whereas others operate kind of similar to your regulated utilities where you sit across from your grantor and on some frequency, you make sure that you're rebalanced around your contracted return and you manage that through different levers in the contract, right? So we've intentionally put together this portfolio with those different elements of diversity so that our LPs can benefit from that, particularly for resilience in some of the down cycles we've seen over time. So with that, I mean, I can go on forever about roads and airports. I really enjoy them, but maybe I'll pause and pass it back to Gary.
Thanks, Ian. No, I really appreciate it. And this map actually is a good visual to your point earlier about, so there's one company here, it's a blip down there in Houston, Texas. It's called Buckeye Partners. It's a midstream asset that we own 100% of. It has pipelines that run from Houston, Texas, all through the southeast, up through the New York, New Jersey area. It provides actually all of the jet fuel to the New York area airports and so forth. It was previously Standard Oil. The business has been around for 140 years. So, I mean, Manhattan has been built on top of this pipeline, right? And Ian and I work in our New York office. There's no competing pipeline being built under Manhattan anytime soon. And so those are the types of investments where, again, having the size that we do, the diversification, we were able to go out and acquire 100% of that. And again, that's a regulated asset that we're continuing to buy and hold over the long term as well. So just wanted to highlight that because while it's one dot, it's an incredibly diversified asset. You have that pipelines. There's also a terminal and storage business in the Caribbean, where again, to Ian's point, provides great diversification during various market cycles, right? If we looked at, for instance, during COVID, the movement of people of goods slowed down. The movement of people slowed down, right? There wasn't as much people flying or driving around and so forth. So those pipeline businesses, there was a decrease in volumes there. The terminal business and storage, there was great crude oil, so then that aspect had some volume linked or market prices there where we were able to capture tremendous upside as that fuel wasn't being transported to the pipelines, they needed somewhere to store it. So that's where it's kind of counter-cyclical, where that's just one asset, where again, different market cycles, it's still able to hit its base case returns because of the diversification embedded in that one portfolio company.
Yeah, so you touched on a question that I had brewed and I was saving for later. So that company in particular has Caribbean exposure assets. Then I see, if I'm not mistaken, Marathon is Turkish port. And so I was wondering if you could talk a little bit about what restricts, when we talk about the OECD countries, what is that evaluation like? Do we have, because I know you guys have a total return type, you're going after it as much as you can. Can we talk a little bit about what those guardrails are? Do we ever have opportunity to get into the frontier countries? So, you know, what are our limits in pursuit of yield? Can we talk about that a little bit?
Yeah, absolutely. So again, from a core infrastructure manager, the number one thing we're focused on is the downside protection first. So that's your first off. So similarly, so the Mersin International Port in Turkey is a great example there. where we partnered with a global power, port authority operator there as well, so a great counterparty mix there. The revenues and expenses of that asset are all in USD, so we're not exposed to the Turkish lira as well. And also, it's the dominant footprint that that asset has in terms of transportation across all of Europe as well as the Mediterranean and so forth, and Asia and so forth. So that's one port where in particular, it has a deep port space where it can service those larger vessels that quite frankly other ports in Europe can't. So it's a great competitive advantage there. And also it's in an area where it doesn't have to deal with the icing or freezing over as the water as often as some of the other ports in Europe will as well. So we're always gonna look for the downside protection and the mitigants there is always the first instance that we do. That was a new geography for us when we entered in 2017 as well. So we worked with numerous senior advisors, consultants, operators. There's actually about 180-page paper put together on Turkey as region and investor in the mitigants. So it's a long process. I think part of the benefits too of having an investment team is we can take that long-term view. So another example would be Sydney Airport, which we acquired in 2020. That asset was one we were performing due diligence on for 5 years. So to the point earlier where we don't have a set investment period where we have to put capital to work for the sake of putting capital to work. If it doesn't check all of our boxes, and we have a very thorough due diligence process where we have deal team members that range from 5 to 12 members. We have a risk director, and then we also set up a peer review team. So that's another handful of investment team members, usually in another office, that are essentially playing devil's advocate. They're trying to poke holes in as many items as they can. So we're patient, prudent investors, and I think having that large team allows us to take that approach where, again, because the fund is so diversified, we can take our time and make sure that there is some complementary benefits to a new acquisition, as opposed to just acquiring a business for the sake of it.
My only other question, the data center exposure, all US or?
So our primary exposure was US Switch, so it was a US data center. It had exposure to 5 campuses across here in the US. This past quarter, we did acquire a new data center, Green Group. It's based in Switzerland. It's another platform investment. We don't think we're not gonna become a data center fund or anything of nature. The exposure to data centers now post acquisition is right around 9%. We're very happy with having a North America platform as well as a European, and really just be kind of diversifying the contracts of those providers versus any other, big acquisitions of that nature.
And the only thing, only other point I would add is, when you see those Caribbean exposures, they're very small relative to the broader company for Buckeye, and certainly relative to the 67+ billion NAV fund. But they're important components of those businesses in terms of how they operate, but they don't make up a lion's share of the exposure.
Yeah, I think that kind of, that and the Turkey, paired with the Turkey, made me say, well, why not Netherlands? What does Brazil look like for you? At what point? And so, but you answered it.
Yeah.
You've answered it. But that's what that was informing.
You'll completely understand, yeah, and the terminal and the storage business are important, because again, you have to have that global platform if you're really gonna be a big player in that space. So you have to be that geographic diversification to have these storage units and so forth. So again, you can align with those customers globally.
And quick questions on my end. How does IFM manage for currency risk, if you guys do? And then what would the contribution queue look like?
Yeah, absolutely. So the fund is denominated in USD. All other currencies are hedged back to the dollar as well at no cost, additional cost or anything to our clients. The current queue now, we're guiding clients towards a drawdown timeline of about 6 to 12 months. And that's likely can be on the shorter end of that. The team has a pretty robust pipeline of deals that are in various stages of due diligence. So we're seeing great opportunities again, where we're able to capitalize on our relationships, network, and size to further diversify the fund as well.
Thank you.
How long you been in business?
So the firm's been around since 1994. And again, in the infrastructure space, we started really with infrastructure in 1995. We have an Australian infrastructure fund that was focusing on investments there. And really, it was kind of as the asset class evolved and further diversified, that's when we globalized the business in 2004.
What do you?
Go ahead. Are your fees negotiable?
So our fees are extremely competitive. So we have a fixed management fee at about 77 basis points. You don't pay fees until you're actually drawn into the fund and so forth. And there's a performance fee of 10/8. So unfortunately, there's no negotiation because we have over 700 clients in the fund. So we have to treat every client equally. We have a fiduciary duty and so forth. But those are our base term rates for the fund.
And the second question would be, if we determined as a committee, we wanted to look at possibly 2 managing partners instead of 1, what's your response to that?
Yeah, no, absolutely. I mean, again, at the end of the day, you all have to do what's best for you. We've done that with several LPs and so forth, where they've made commitments to us and another manager. That's fine, especially as programs grow. So there's no issue on our side from that.
What do you see, I mean, how do you perceive if the current trend of de-dollarization in the global context, what impact would you see in your portfolios?
Sure. I think, so it really depends based on the sector and subsector that you're talking about. Any further de-dollarization would obviously present itself differently. I'd say that the one thing that we'd anchor to is, as you look across a number of different macroeconomic cycles that have been caused by different shocks, is infrastructure remains quite resilient because these are essential services, right? And they're typically, unless you've got a diversified portfolio type play asset, they're usually serving a certain jurisdiction. And so you're really looking more for those shocks or economic and macroeconomic considerations that are narrow to the jurisdictions in which they play, and then you assess it on a case-by-case basis. I think the assets that naturally will be monitoring this around are those assets that facilitate global trade, so some of our airports that are heavily air cargo driven, or some of the roads we were talking about that are really focused towards moving freight, and of course our seaports. But at the moment, we don't think that that's having so much of an outsized impact that it's a near-term consideration for our assets in the portfolio, but it's something obviously we'll continue to monitor going forward.
No, since you're saying your measures are based on USD, what if the USD loses its value compared to euro or any other currency?
So that was that one asset that I was talking about there at Mersin Airport, where again, we're not exposed to the lira, the revenues are USD. Otherwise, the global platform, I mean, they operate in the local currencies that they are planning. So whether it's the euro, British pound and so forth. And so again, our hedging program is, again, we're not looking to drive value through the hedging program or anything of that nature. We only hedge if it adds prudent value to the actual returns to the portfolio. But again, at the end of the day, the fund itself is denominated in USD.
And what is your lock-in period?
So once you're drawn into the fund, there is no lockup period. So we have quarterly liquidity once you're exposed to the fund. So if a client's drawn in and next quarter, for whatever reason, they have to rebalance and so forth, it's a redemption letter you complete and it pays out the following quarter.
Okay, thank you.
Yeah. And another point too, I just mentioned there in terms of the distribution. So again, there's steady distributions for the fund. They're typically made semi-annually. Investors can elect to either take those out as cash or reinvest those back into the fund. You can change that election once a year as well. So in terms of the terms of the fund, they're extremely LP friendly in terms of the fluidity to make those changes.
Thank you.
I'm sorry, Gary, in your introduction, I missed Ian's last name and your title with the company?
Sure, Pearson is my last name, and I'm an investment director, and I sit in New York with the North America team.
Really appreciate the time. Thank you very much for the consideration. If there is any questions, please feel free to reach out. Happy to be a resource and let you answer any questions you have.
Thank you.
Thank you.
Thank you very much.
Yes, that's a great slap. Well, another question, Chairman Kennedy, we were scheduled to be here till 3, we won't be here till 3, correct? Oh, good.
That was a pleasant surprise.
I thought it was gonna be like an after presentation meeting, okay. Good,
Got to stretch a bit.
you done.
I have a question. Did you go to St. Martin's?
I did.
Graduated 2011?
2012.
2012, okay.
Yes.
I think you know my little brother, Otway Denny.
Oh, my gosh, yes.
You looked so familiar. I was like, I'm
Oh,
seeing you as a
yeah.
10-year-old, but
Oh,
okay.
yes.
Did you all just have a reunion?
Yeah, how is he?
He's doing great, yeah.
Yeah.
Well, thank you all for having us. It's great to be here. I'm Matt Bolger. I'm a relationship manager on the East Coast for Macquarie Asset Management. With me is Peter Bendel, who leads our portfolio strategy for Macquarie Global Infrastructure Fund, and Eli Alcantara, who leads our government and corporate affairs initiatives across the Americas. He also worked under the Obama administration. So just getting into the presentation quickly, and I'll go for about 20 seconds, then I'll pass it off. Macquarie Asset Management has about 477 billion in assets under management. 233 billion of those assets is in infrastructure and real assets, which makes us the largest infrastructure manager globally, with over essentially 30 years of experience investing in the space.
How long you been in business?
Macquarie as an organisation has been in place since the 70s. So we've been involved in a number of different business work streams, whether it's on our investment banking side, traditional lending, but asset management, in particular infrastructure, has been central to our business for the last 30 days. It's certainly, last 30 years, it's certainly very essential in terms of the DNA of
So you see on this slide, just quickly, is our global platform with offices all over the world and local boots on the ground, and Pete will go into more in depth on that in a little bit. And then we just wanted to touch briefly on our inclusion journey. So we feel that we are creating a culture where everyone feels safe, seen and connected, which we think creates better investment outcomes ultimately in the long term. And we've also built this out within our 187 portfolio companies around the world as well. With that, I just wanted to kick it over to Eli to talk about some of our local presence in Louisiana.
Yeah, and I'll just start by saying, in leading the work across the Americas, we're rooted in a couple of core pieces of philosophy. One, and really in many ways globally, we believe the community gives us a license to operate. We don't grow to this scale, particularly in infrastructure. We're real assets that serve communities, and in many ways are fiduciaries of managing pension dollars and investment in those infrastructure if the communities don't give us that license to operate. The second core piece, which holds true in Louisiana, where we have 2 decades of experience investing, is that we don't want to be the first call when we make a call to an elected official or public official, be the one when we need something. Undoubtedly, that we'll need something, there will be partnership, but we want to have created that relationship in a very warm way. As Matt mentioned, a deep experience in Louisiana across the team before joining Macquarie, and at Macquarie, again, 2 decades of experience investing. Across the board, I'll just mention early investments, IMTT, which you all may be familiar with, headquartered here in New Orleans, investment in 2006, largest liquid bulk storage company on the Eastern Shoreline. Have a lot of experience there, and Peter led a lot of that work through Macquarie Infrastructure Corporation. To CLECO, to Treaty Oak, which focuses on renewable energy, and DESRI as well, which is a global regional platform that has extensive projects in the state of Louisiana. And Dynagrid, which is a utility services company which partners across the board and is doing some significant work in the state of Louisiana. And Diamond, which is a strategic partnership with Dow Inc., which serves industrial clients and is completing work across parishes like St. Charles and others in the state of Louisiana. I'll end quickly before I turn it over to Peter with Swift Fiber, because we're very proud of that investment. It's an investment we made in 2023. It is a fiber company rooted in extending and connecting underserved communities. And our investment there and partnership, the reason why we decided to invest in Swift was rooted in that notion of connecting across local, state, and federal opportunities to expand broadband through programs like Gumbo, which you all may be familiar with here. The Granting Underserved Municipality Broadband Opportunities Program here in the state of Louisiana, to the BEAD program, which was established under the Biden administration, and in many ways was clawed back in entering the second Trump administration, but we were able to work closely with the state and the federal government to ensure that close to $300 million were partnered in and invested in SWIFT to ensure at minimum 60,000 new homes are connected to broadband to up to 390,000 homes across the state of Louisiana. Just to give you an example of how to kind of end on where I started, the community gives us license to operate. We take that very seriously, and we deepen our partnerships in order to get things done, even when the landscape may be a bit more complex in this moment. With that, I'll turn it to Peter to.
What percentage of your total portfolio is invested in Louisiana?
I'm sorry, I didn't get the question.
What percentage of your total portfolio is invested in Louisiana?
In terms of our global 260 or so billion of capital, got the numbers up here on the page. We quickly do the math, and it's probably going to be 1 or 2% of our global portfolio, probably less than that, to be fair, in the context of what our global platform is. But I think in terms of our presence here, I think relative to other states around the US, a relatively higher portion. And we're very proud of that. We've obviously been doing this here for 20 years and plan to obviously be in the state for a lot longer going forward. The examples obviously Eli has laid up on the screen here. A number of these are examples of predecessor funds or other vehicles. Today we're here to talk about our Global Core Infrastructure Fund, and I'll spend a bit more time focusing on its strategy, key differentiators in terms of what LPs have committed to the fund found appealing in terms of MGIF, and then going into a bit more details in terms of what does the portfolio look like today and where we think that's going to move going forward. So with that on the slide here up on the screen, so MGIF is Macquarie's Global Core Infrastructure Fund. So it's targeting a 8 to 10% net return and a mid-single digit yield. And it's really looking to invest in those traditional infrastructure sectors that we're all familiar with when we think about infrastructure. We're talking about regulated electric utilities, talking about regulated toll roads or network toll roads. The assets that are essential to everyday life, to economic activity. These are the types of investments we are aiming to and have been investing in. We've been investing in these segments for a long period of time, and I'll come back to our track record in the space in a minute. But importantly, as Eli points out, for us, these are very high profile, typically monopoly assets, and therefore our relationships with our stakeholders, with the communities in which we're investing, are paramount to the success of what we're doing here. I'm going to step through a few differentiators as why Macquarie can deliver on that relative to others. But before I do that, just a few of the headlines in terms of the fund. Since we launched this fund in 2021, we've now raised about $7 billion in asset size, raised from about 100 or so different investors. MGIF is a relatively new fund that's wholly consistent with what we've been doing for the last 30 years in terms of investing in the core infrastructure space, and I'll step through that in more detail. Importantly, this fund, obviously, as I mentioned, is a global strategy, so we're investing across the regions. We do, though, have, for investors who are interested in them, hedge feeders. So if you are looking at not investing in an unhedged exposure, a US dollar hedge feeder is available, which we don't charge additional fees for, on a systematic hedging structure. Maybe stepping into some of the differentiators of what MAM and MGIF provides. So on this slide, what I want to try and bring out is Macquarie's deep expertise in infrastructure. So this is just the track record relevant to our core infrastructure businesses in terms of MGIF. It's not our total infrastructure platform. But as you'll see in the centre here, we've invested in 137 portfolio companies over the past 30 years. And importantly, we've realised over 60 of those investments. So unlike many others who maybe have only invested in, 10, 30 or so investments, we've realised over 60. And those investments, as I mentioned, have been over the last 30 years. It's been through the various economic cycles. So whether it's a global financial crisis, whether it was COVID, we've been managing assets throughout this period of time. And through all that, we've successfully delivered, on the right-hand side, that kind of net 10% return to investors.
Can you explain what realised means?
We've sold those assets. So we've made investments, we've held them, we've hopefully improved those businesses over the whole period, and we've exited. So in terms of our track record, this isn't just a mark where an independent valuer is saying, here's the valuation, we think returns are this. This is actual realised outcomes that we've been able to generate for our investors over that period of time. So that return of 10% we're very proud of, and it's wholly consistent, as you recall, in terms of our target returns for MGIF going forward in terms of 8 to 10% net target. On the left-hand side of this slide, I just want to highlight that performance has been across all the same sectors we're expected to pursue going forward. So we've done this across transport, across utilities, contracted energy, digital assets, and we've done it across geographies. We've been investing in Europe, we've been investing in the Americas, investing in Asia Pacific. So all these regions, stands behind this track record. So what does that mean in terms of MGIF? And going to the next slide.
What is your digital asset definition?
So digital infrastructure for our MGIF, for the core strategy, what that's going to look at is 4 key segments. Firstly, we're looking at stabilised operating data centres. So there's been a lot of focus around data centres in terms of growth, building new ones. We aren't necessarily interested in that. We'll be looking at standalone operating long-term contracted assets, most likely with a cloud compute background. Now, in today's market, everyone's paying really high prices for those. We have not invested in that sector to date, and we'll be cautious about entering. Another segment could be cell phone towers. I've spent a lot of time investing in the space over the years. That provides, again, long-term predictability, very stickiness. We all love using these things. We aren't going to stop using them. So it provides very strong predictability in terms of volumes. Thirdly is fibre, so rolling out. So the Swift business that Eli mentioned that we have here in Louisiana, it doesn't sit within our core category though. There's a lot of growth. You're building out new connections, you're taking risk in terms of will customers connect. That's not the risk profile we're looking for here. What we'll be looking for is a monopoly concession to provide fibre to a certain region. In the US, that doesn't really exist. You typically see that more in the European context, where you see concession or monopoly style platforms for investing in fibre. And then finally, the other segment we'll be investing in would be registries. So how to simply put this, think about the DMV, the Department of Motor Vehicles, privatising the DMV and being responsible for managing the data set and providing services to the community, whether it's licensing, registering vehicles, vehicle background checks, those types of services. So that's kind of the digital spectrum. I would say, again, as I mentioned, in relation to data centres, this segment has been more expensive lately. And it's been an area we've been more careful in terms of approaching and being focused much more in this portfolio to more the traditional side.
So when you were talking about kind of the profile of the businesses you had in Louisiana, those are definitely much higher risk and newer. So that is in your main infrastructure strategy, or that would be in the strategy you're talking about for us to invest in today?
So of those businesses, most of those were in predecessor funds that have kind of been in that realised bucket, or they're sitting in the higher risk spectrum, other than Desiree, which is our solar platform here in the US. And I'll speak a bit more about Desiree further on. So Desiree has about 5 projects, just over 440 megawatts of operations here in Louisiana. So in terms of the strategy here, look, first on the left-hand side of this slide, those pie charts on the left, wholly consistent with the pie charts I showed you on the last page in terms of what we've been doing for 30 years. We're going to keep targeting that going forward in terms of this strategy. Importantly, though, notwithstanding that track record and the experience of those assets, we want to bring a modern vintage to investing in this portfolio. And that doesn't mean technology or digital exposures. It means what are the thematics that are going to be relevant to infrastructure assets in their communities, such that they remain relevant to their communities over the next 20, 30 years. So what does that mean? That means we're going to be more cautious about things like midstream assets, like our IMTT business that we own here in Louisiana, which is the largest liquid bulk storage business in the US. Those types of assets, you own a midstream asset moving fuel from point A to point B, they've been historically a very attractive infrastructure class. Even today, long-term contracts, high EBITDA margins. You need to ask yourself a question. In 10 years from now, who's going to recontract that capacity? Is that demand for that fossil fuel still going to be there? If you are successful in recontracting it, who's going to be the institutional investor who's going to buy that asset from you to hold it for the next 10 years thereafter? And therefore, what we are identifying is what's your terminal value risk? What's your exit exposure for those types of assets? We're not saying they're bad assets, but the risk profile you're pursuing is different to some other segments that have strong tailwinds. So for example, we've gone very long into investing into electric utilities. Why do we like electric utilities today? Everyone will talk about the regulated structures, the strong decoupling from volume exposure, the ability to pass through inflation. All those characteristics are really important. But what you're also seeing, particularly in a place like the US, is really strong tailwinds around digitalization, which means as we all consume more data, it needs more power, more energy. And you're seeing an onshoring of manufacturing, increasing industrial capacity here in the US, which also needs more power. So what we're looking to invest in are the poles and the wires that move those electrons to those consumers. And we do that in a regulatory framework. So positive tailwinds, these assets are going to be needed by the communities for decades to come, but we aren't taking risk in terms of does that data center win or does that data center win? We're just looking at the broader community demand for the energy. On the right-hand side of this page, I want to try and bring out what do we mean in terms of infrastructure. We're really looking for the core traditional assets. These are brownfield operating assets that are essential to everyday life. They're generally mature businesses. They've got long operating track record. And that's not just in terms of how they operate as a business, but also the jurisdictions in which they sit. We're investing in OECD markets, and arguably the more understood OECD markets. So we want to do places like Mexico. Because those types of markets, if you move away from OECD, they introduce new risks that push you up the risk curve in terms of your allocation. So for this strategy, we're OECD focused and arguably, again, the top echelon of that in terms of risk profile. And that's really important because at the end of the day, as Eli mentioned, stakeholder management and understanding your counterparties is critical to having that social license to operate. If you're investing in jurisdictions that have a little bit more volatility, that becomes obviously a higher risk situation. And importantly, getting all the key characteristics that you're after in terms of infrastructure, downside protections, inflation hedges, all the things that people have spoken to you about in terms of what the characteristics of infrastructure are. And these things really come out more strongly when you're talking about these core traditional asset classes within infrastructure. So how do we execute on this? And no doubt everyone you've spoken to has talked about their teams, the fact that they are large around the world. We have the largest, 400 investment professionals around the world. And they're not just based in New York or London, they're based in the countries in which we own these investments. They are on the ground. We have Eli here in the US interacting with our stakeholders here. We have his counterpart in Italy or in France or in the UK. And the idea is they are on the ground, they're understanding what's happening, whether it's regulatory headwinds, tailwinds, political noise. That's really important to understand. How does our assets sit? And importantly, their ability to then select what are the good assets we should allocate versus the mediocre assets you should allocate in any one market. So we'll have our utilities team in the US, utilities team in Europe, a utilities team in Asia Pacific. And it's their job to be out there in the market, screening and assessing opportunities for us, understanding the spectrum of opportunity that presents, and bringing up these ideas to me and my team in terms of selection of what goes into the fund. These individuals, as I mentioned, obviously they're responsible for that, but they're also responsible from an end-to-end perspective. They're finding the opportunities, they're executing the investment opportunity, should we be supportive from a fund perspective, and then they're responsible for managing the asset on an ongoing basis and eventual exit. That accountability to our team is really important. We want to make sure they're on the hook from the start to the end. We're not having an M&A team who passes the asset off to an asset management team. It is consistent across the work streams. And we break up our team along the lines of these sector specialists I mentioned, like utilities teams, for example, who have those relationships. But we complement them with functional experts. So we have people in our team who are experts in workplace health and safety, in procurement, in IT implementations, in cybersecurity. And they are on the team. These aren't operating partners that we bring in for a deal or third party. They are actually within the Macquarie team. And they're helping all of our platforms then uplift their operating performance and implement best practices from our perspective in terms of operations within their markets. And we're doing this all within that framework that Matt mentioned around inclusion. We want all these people feeling safe, seen and connected, such that they'll raise their hand about issues. That allows us to make better decisions, identify issues earlier. This is a really important framework, and Shamar, our CEO, has been very front and vocal about this for many, many years, and continues to be fundamental to how we want to operate, not only ourselves, but we want to implant this into the infrastructure businesses that we invest in. So I've talked about a bit of those differentiators, what makes Macquarie different from our peers and what allows us to do what we do successfully over such a long period of time. In terms of this portfolio and what we've currently done in terms of implementing our strategy, as we'll see here on this page, we have our 9 portfolio companies. And I want to provide a little bit of colour in terms of what this means. Because you'll see a lot of people talk about a larger base of assets, but what these assets represent have significant scale. So for example, National Gas on the top left. National Gas isn't a one pipeline connecting point A to point B. It is the entire gas transmission network of the United Kingdom. The entire United Kingdom's gas transmission network is owned by ourselves. That means all the gas molecules that are move through our pipeline. That means what we're providing is an essential service that provides heating to 23 million homes. It provides the energy for commercial and industrial activity, production of paper, production of glass. It provides the gas that fuels 1/3 of the UK's electric generation. 1/3 of the UK's electric generation relies on these pipes. UK can't operate without this asset. This is the profile of investments that we make, and obviously that diversifies your risk across a very deep base of customers, types, and obviously different uses in terms of that infrastructure. Autostrade per Italia in the centre of the page. This is our Italian toll road network. Again, not one toll road, but it's actually 16 toll roads covering 3,000 kilometres across the entire country of Italy. It in fact represents 51% of all the toll motorways in Italy. 51% of toll motorways is in this portfolio. That allows us to diversify our risk in terms of any exposure. So we aren't talking about one toll road in the US, for example, connecting point A to point B, and you're exposed to economic activity along that. We've diversified that. Additionally, this network, it's regulated. So the volume risks that you might see in terms of transportation, which are obviously elevated in today's environment as we see shifting of supply chains, geopolitical impacts, we're de-risked. Because volume risk we pass back to the regulatory model. We can increase tolls should volumes come down to ensure the economic protections for our investors. So again, sizable opportunity. And finally, last thing I'll mention, Desiree, which we've talked about briefly in terms of its exposure to Louisiana. But in fact, Desiree has 80 projects, or more than 80 now, projects across all energy zones in the US, representing 12 gigawatts of operating in construction and contracted assets. So 12 gigawatts, that's millions of homes worth of power generation. That diversification across the entire US means you have resource diversification, you have contractor diversification, and also in the current climate where you're seeing growing energy demand in the US and the focus on getting power delivered on time and quickly, whether it's utilities looking to beef up their energy to support manufacturing, or whether it's data center companies looking to deploy their assets. DESRI as a scale player is only a handful who can actually deliver on that on time, on budget, and as a reliable partner. So very well positioned to benefit in those tailwinds around energy demand in the US. So I hope that gives you a little bit of colour in terms of the pipe into the portfolio. I don't want you to look at 9 portfolio companies and think it's just 9 single assets. There's obviously a lot more beneath these. And as we look forward, again, those 400 investment professionals around the world that we have who are looking for new investment opportunities for us, we're looking at probably raising around $1 billion, $1.5 billion US dollars per year for this strategy. That requires 1 or 2 investments per year for us to be successful. 400 investment professionals with long track records, we need 1 or 2 good ideas to allow us to deploy in a disciplined and patient manner to select the best assets we can find globally. We think that's a really, really powerful lever that we have, and me and my team really benefit from, because we can keep lots of options alive and keep plates spinning so we can choose what makes sense at any point in time. At the moment, to your question earlier, data centers, maybe it's not the right time. We're pausing. We're spending time at the moment, we're investing in utilities. In 5 years, that may pivot. And we want to take that patient approach and not force ourselves into a pretty pie chart in our sector materials.
Quick question. Energy, I mean, at least on the public side, is known to be volatile. How does Macquarie manage for that? And is some of that energy, renewable energy exposure contracted to kind of stabilize that performance?
So our regulated utilities, we don't take any energy volatility exposure. So it's all just passed through to the end customer. For our solar platforms, the weighted average contract life is 20 years. So very long visibility in terms of the pricing you're receiving for that asset. What we're actually seeing in today's market, given that growing demand, is we've actually been executing contracts on average close to 24 years, more recently here in the US. We're actually seeing better terms because of those positive tailwinds around those PPAs. So as we think about MGIF's portfolio, and maybe I'll skip forward to slide 19. On the left-hand side here, what we want to try and bring out is what is the revenue profile that you as an investor get when coming into MGIF? And importantly, the cash flows of our businesses are regulated or contracted. We don't have volume exposures in this portfolio. We aren't seeking that type of risk profile. We're looking for that predictability, those traditional characteristics you want in infrastructure. So if you think about global events at the moment, and as unfortunate, and hopefully they come to an end shortly, those types of events don't necessarily flow through because people are still going to turn their lights on in their homes in the US. People are still driving on the roads in Italy, or the regulatory frameworks will provide protections to ensure we still collect the appropriate amount of revenues. They're the types of assets we're looking to. We're decoupled from global GDP as we think about the exposure you're getting. And this really goes back to those traditional infrastructure assets that investors seek to look at. Also on this page in the middle, inflation protections. I think obviously it's a very strong characteristic for infrastructure generally, so I won't harp on this too much because obviously everyone else their portfolios will likely have a similar profile. But importantly, the vast majority of our cash flows have a direct inflation link. So either the regulation allows you to adjust tariffs as inflation increases costs or increases your capex, or our contracts have a specific inflation adjustment, maybe on an annual basis, so you're able to pass through that impact. What that has allowed MGIF to do over the past few years is see very strong cash flow growth because you've had elevated inflation. Our portfolio has therefore seen a nice step up in terms of its revenues. And I think as we've developed this portfolio, that's been a really important consideration. The macroeconomic environment today is very different to what it was 5-10 years ago. Inflation's higher, interest rates are up, And therefore, the returns you should all get in terms of investing your capital in infrastructure is higher. We've been investing in these assets in this fund over the last few years. So we're already factoring that in. We're pricing that into how we're buying assets today versus being an older vintage portfolio that bought assets 10, 20 years ago and do their NAVs today reflect current valuations. I think people have found it attractive to see the recency of these investments because of the significant change in the macroeconomic environment we've seen more recently. And then finally, in terms of this slide, on the right-hand side, we have prudent leverage. So what does that mean? We have these stable, predictable cash flows linked to inflation that we've seen strong growth in over the last few years. We're underpinning those, though, with long-term, and the vast majority of that fixed or hedged. So 9 years on average tenors, close to 90% of that fixed or hedged. So that means that we've seen rising interest rates, we're protected. The rising revenues are flowing straight through to equity. So this provides obviously enhanced returns, and that's why we've seen MGIF performing at the top end of its target returns since we've incepted the fund, which is obviously very, very pleasing. But it also means that we're able to have ample access to debt capital markets to keep funding our businesses. So as I mentioned, large projects, whether building new toll road in Italy, building out pipeline networks to increase energy security in the UK, we need a significant amount of capital to do that. So therefore, having access to debt capital markets on attractive terms means we can keep funding these plans on an ongoing basis and allowing us to generate a relatively attractive spread. So we're issuing debt in this portfolio probably around the 5 to 6% level, all-in rates, paying for our debt or recent issuances. Equity returns have been circa 10%. So a nice 400 to 500 basis point spread for core infrastructure exposure on a risk-adjusted basis compared to the similar debt return if you're investing in these types of assets, which we believe is relatively attractive. So with that, look, I wanted to just reinforce, I think from the Macquarie perspective and in terms of this strategy, it's differentiated from our peers in terms of our capabilities and our experience in the sector, from our focus in terms of ensuring we're going after truly core infrastructure assets, those traditional assets that have those right characteristics that our investors are after that come from infrastructure. And we're leveraging the largest team in the market with the capabilities to be able to keep sourcing good ideas and importantly managing these assets and managing the stakeholders and relationships we have around these to make sure we maintain our social license to continue to operate. So with that, I think our prepared remarks run through, and certainly welcome any questions.
What is your minimum amount of investment and for how long?
The minimum amount from an investor coming into the fund. So on our documents, we'll have a 10 million minimum equity check. We have accepted checks more than that on a case-by-case basis.
What's the period, minimum period?
What's the minimum?
Period where you would want
Hold.
this fund to hold.
The whole period, so we see this as a perpetual vehicle in terms of MGIF. That doesn't mean the portfolio companies within it will hold in perpetuity. So we're generally looking at underwriting these investments on a very long-term basis. So we're looking at 20, 30 plus year models.
He's asking about liquidity.
Liquidity in terms of,
Yeah, investor liquidity.
we have quarterly redemptions.
Yeah.
Sorry, thank you for clarifying.
I have a few questions. One, I wanted to make sure we're clear the track record of Macquarie. So just Macquarie Infrastructure versus the inception of MGIF. I was wondering, and I know you went through this, but I just kind of want to reiterate those two timelines. When does MGIF start?
So MGIF was 2021, we launched the fund. The first investments were the start of 2022. So we're about 4 years through investment period, and that's generated that circa 10% local currency return and just above that in US dollar.
And so, and
What's the
then,
value of that fund and how many investors do you have in that fund?
So MGIF, that's the 7 billion on the first page that I mentioned. with 112 individual investors. Actually, we just had a closing this week, so actually had 120 investors, I should say, as of today.
That's good.
So those investors are predominantly pension plans, public and private pension plans, probably 70% of the capital coming from those types of investors, and about 20% from insurance companies, again, long-term capital.
And I know this will mirror for MGIF and the previous funds, right? With the target for infrastructure being 8 to 10, can you tell us a little bit about, and I know we don't have a 10-year track record for MGIF, but what any outliers look like? Can you speak to volatility or lack thereof? Do we have a few years in a decade where we are below 8 or over 10? And that may influence my last question. I think significantly, you all as a firm have exposure, great exposure, I would argue, in Pacific as well as South Americas. When you say Americas, you actually mean Americas. I think you all either have offices or holdings in Sao Paulo or Rio. Is that right? Sao Paulo. Yeah. And so when we talk about the OECD countries, just that whole analysis, I'd like to hear a bit about what your guardrails are. Like where are our limits and where are our opportunities, if there are some, if that makes sense?
Yeah, so from a geographic perspective, this fund solely OECD focused, that's the mandate that we're looking at, and all the assets are OECD. Macquarie's platform obviously much broader, and we have other strategies in the core plus or higher value add type of strategies that will invest in markets like those, but you should not expect to see those types of exposures in this strategy. Okay. And so your first question.
Yeah, so just speaking to that target range.
Yeah, that target range, so yeah. We set this target of 8 to 10% based on what we've seen over the last 30 years. We thought this is an appropriate target return. I think you have seen some compression in core infrastructure returns from when we were investing back in the 2000s. I could invest in a regulated utility at kind of mid-teen type returns. You can't do that today. So you've seen some downward pressure. So the 8 to 10 kind of reflects that when we set out on the strategy. I think what you're seeing in today's market with that elevated interest rate and inflation environment is that you, as investors, should be seeking for these traditional core assets to be at the higher end of that range. And certainly that's where MGIF has been performing to date. And as we're looking at new investment opportunities, we're certainly thinking more towards the top end of that range, just given where rates are. Now, if we see obviously rates head back down to zero, and I'm not suggesting they will or nor be forecasting that, I would suspect you'd see returns start moving back towards the 8% type level. Sure.
Any other questions?
No.
Thank you.
Thank
Thanks,
you.
everyone. Appreciate your
Thank you.
time. Thank you. Thanks, everybody.
Thank you.
All right. Continuing on. Berto, I haven't asked for our next meeting. If we could get a presentation on this asset class relative to our other, and I'll say defensive positions, so our bond portfolio. I think that the committee would benefit from understanding where this segment fits in the portfolio. What is it similar to? Because I think in our evaluation process, we're looking at firms that have slightly different risk profiles. And so I think that'll be a relevant conversation.
Okay, no, perfect, we could do that. And then when is is that already scheduled?
I don't.
Next Wednesday.
It is? That's.
Next Wednesday, April 8th.
Okay.
Yeah.
So then an analysis of fixed income versus infrastructure.
Or anything else that correlates. So if
Okay.
our real estate comes into play, we
Gotcha.
wanna see, I want everyone to see where our defensive positions, where are we supposed to be stable and balanced, you know? So we don't need to get into small cap or, you know, but yeah, fixed income, real estate, and I don't know if anything else would apply in our portfolio, but.
Got it. No, yeah, we'll take a look.
Any other questions for Marquette, Alberto with Marquette? Okay, then, yes.
No, I'm
Oh,
sorry.
okay. Okay, great. Then, next, are there any public comments?
No public
No
comment.
public comments? Great. Then, if there are no other matters before this committee, I'll entertain a motion to adjourn. Moved by Director Makbul, Trustee Makbul, second by Director Pacho. All in favor? Aye. Meeting adjourned. Thank you very much.
Thank you, sir.